Bitcoin up 21% on the year. Gold up 28%. Right? What I thought Bitcoin was supposed to be the fastest horse in the race, right? That's what, who said that? That was Paul Tudor Jones, right? Oh, I'm buying Bitcoin. It's going to be the fastest horse in the race. Well, it's, gold's got a nice lead this year on Bitcoin. In fact, I think they're sending Bitcoin back to the stable. In fact, eventually they're sending Bitcoin to the glue factory. When Donald Trump proclaimed that America was on the cusp or beginning, whatever, a new golden age, I said he means that literally. It's going to be a golden age for gold. And so far, gold is shining bright in the Trump presidency. But what's shining even brighter are the gold and silver mining stocks. So while everybody wanted to buy fool's gold and Bitcoin-related stocks, had they just bought gold stocks instead, they'd have made a lot more money.
The biggest bull market of 2025 is happening right under Wall Street's nose, and almost nobody is talking about it. Gold's price doesn't move because of how much miners dig out of the ground. It moves because of who is buying, and right now, the buyers that matter most are central banks. Goldman Sachs has highlighted this shift, and Peter Schiff has been advocating for it for years. The trend is clear. Foreign central banks are backing away from US dollars and treasuries and piling into gold. The Federal Reserve is helping them make that decision. By keeping rates low despite sticky inflation and preparing for another round of monetary printing, the Fed is signaling to the world that the dollar can be sacrificed. Gold, in contrast, holds its value. What's striking is how differently the public is reacting. Retail investors are still unloading gold and silver, convinced prices are already stretched. Schiff argues they're missing the big picture. Gold is up 28% this year, already outpacing Bitcoin's 21%. The supposed fastest horse can't keep up, but the real story isn't even gold itself, it's the miners. The GDX and GDXJ ETFs, which track primary and junior mining companies, have increased in value by nearly 80% in 2025. That makes precious metals miners the top-performing sector in the market, hands down. And yet, you wouldn't know it by turning on CNBC or Bloomberg. Their focus is glued to Bitcoin headlines, MicroStrategy, and big tech earnings. Meanwhile, the most substantial rally of the year is flying under the radar. Schiff calls it a stealth bull market, and for those who see it early, the upside may have only just begun. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The rotation that we've had, with foreign central banks out of dollars and out of treasuries into gold is going to accelerate as a result of this shift in Fed policy, right? Central banks are going to be more interested and more aggressive in their movement out of US dollars because the Fed has basically said, we are going to sacrifice the inflation side of the mandate because of the political pressure put on us by the Trump administration, which is still early days. We still got, 3.5 years left of Trump, and wait till Trump, gets complete control of the Fed. Wait till Powell is gone and some flunky has taken his place and they get some more FOMC members, right? He's going to completely have control of the Fed. And that means get rid of your dollars. That means buy gold. And again, it's not just central banks that should be doing that. Everybody should be doing that, right? Individuals should be doing that. They're not doing it yet. Again, I talk about the fact that at Shift Gold, it's not like our phones are ringing off the hook. They should be. Right? People should be calling in droves. We probably, we still get more people, I think, selling their gold and silver. They think they're getting a good price. They're getting a lousy price. Gold and silver prices are just going to keep going up. Why? Because the dollar is just going to keep going down. Powell just told you that, right? We're going to sacrifice the dollar. We don't care, right? We're cutting rates, even though inflation is above target. But more importantly, they're going to go to QE because what is going to happen? They're going to cut rates and long rates are going to go up. Then what? Because they want long rates to go down. That's the main goal. So the government, they think, can refinance the national debt at lower rates. They want to goose the housing market, right? Instead of doing the right thing by letting home prices go down, they want mortgage rates to go down so people can overpay for these homes. But when mortgage rates don't go down, then they're going to still want the Fed to bring them down. And how are they going to do that? Quantitative easing, where the Fed goes into the market and buys treasuries, or maybe starts buying the mortgage-backed securities again. They haven't been buying them at all. They've just been buying treasuries. In fact, they've been selling mortgage-backed securities as part of quantitative tightening. So obviously that's going to come to an end. I mean, that may come to an end in September. But there's going to be a lot of pressure on the Fed to resume quantitative easing in order to bring interest rates down. And that is going to bring the dollar way down. And you got to prepare for that. Look what happened to gold prices. Again, gold up. Gold is up 28% this year. It's a nice move, right? The year's not over yet. Now, Bitcoin got all the headlines in 2025. That's all the financial community could talk about. Bitcoin is barely up. In fact, it's not even up 22% year to date. In fact, it was up 22% when I first started the podcast, but now it's dropped about $1,000. When I started doing this podcast about 40 minutes ago, and I looked at Bitcoin, it was 113,500, and it wasn't up 22% on the year. Now we're down 1,000. So Bitcoin isn't even up 21% now. It's at 112,500. So Bitcoin up 21% on the year. Gold up 28. Right? What? I thought Bitcoin was supposed to be the fastest horse in the race, right? That's what, who said that? That was Paul Tudor Jones, right? Oh, I'm buying Bitcoin. It's going to be the fastest horse in the race. Well, it's, gold's got a nice lead this year on Bitcoin. In fact, I think they're sending Bitcoin back to the stable. In fact, eventually they're sending Bitcoin to the glue factory. But look at the gold and silver mining stocks. The GDX and the GDXJ were up 3 1/3% on the week. And the GDX and the GDXJ closed the week on new multi-year highs. I mean, maybe 12, 13-year highs. Year to date, the GDX is up 77.5%, and the GDXJ is up 78.5%. Those are huge returns. And, we're not even at the halfway mark for the third quarter, and we got those kind of returns. These gold stocks are on pace to more than double as a group in 2025. I said this when Donald Trump proclaimed that America was on the cusp or beginning, whatever, a new golden age. I said he means that literally. It's going to be a golden age for gold. And so far, gold is shining bright in the Trump presidency, but what's shining even brighter are the gold and silver mining stocks. So while everybody wanted to buy fool's gold and Bitcoin-related stocks, had they just bought gold stocks instead, they'd have made a lot more money. And in fact, even though gold and silver mining stocks are the best performing sector of the market, right? By far, there's not another sector that comes anywhere close, right? Precious metals mining stocks, hands down, the best performing group in the U.S. Why do they get no coverage? Turn on CNBC, turn on Fox Business. They don't talk about these stocks. I mean, maybe you get to Fast Money on CNBC and somebody will say, yeah, I like Barrick Gold. I like the GDX. Okay. Yeah. Someone will mention that like as a pick, but they really don't focus on it. Instead, they spend so much coverage on Bitcoin and MicroStrategy. You're much better off on the gold stocks this year than MicroStrategy. I mean, not even close. So this is a stealth bull market. No one is talking about it. The financial community isn't covering the story. You have the best performing sector in the market, and it's not even worthy of coverage as far as the media is concerned. They're missing the boat. People who rely on financial news are missing the boat, right? If you're watching my podcast, if you're relying on the Peter Schiff show, then hopefully you're not. Hopefully you're following my advice and you're buying gold and silver. And more particularly, you're buying the mining stocks because even though they're up 78% on the year, they're still cheap. That's how cheap they were before they went up. So there's plenty of time to buy these things. And the fact that the media hasn't even noticed it yet, that shows you how early we are. I mean, when did the media start talking about Bitcoin? Think about how much Bitcoin went up before CNBC finally jumped on the bandwagon, right? I mean, and so imagine where gold's going to have to be before we get a bunch of believers there.
Friday's surge in the markets didn't last long. By Monday, reality set in as investors began questioning how far and how fast the Federal Reserve is willing to cut rates and what that means for the economy as a whole. Peter Schiff used the moment to revisit one of the Fed's most confusing policy ideas, inflation averaging. When Jerome Powell rolled it out, the pitch was that inflation needed to run above 2% for a while to compensate for years when it had been slightly below target. It sounded technical, but Schiff argued it was nonsense from the start. Nobody wanted their grocery bill or rent to rise faster just so the Fed could balance its math. It was nothing more than a clever excuse to avoid raising rates. Here's the flaw Schiff keeps hammering. If averaging were truly the goal, then after multiple years of inflation running hot, well above 2%, the Fed should now aim for inflation below that level to bring the numbers back in line. That would be real averaging. Instead, Powell has abandoned the idea entirely. The new line is to get back to 2%, though even that target is proving elusive. Inflation is still running higher than it should, eroding wages and household budgets. Despite this, the Fed is preparing to cut rates. Schiff warns that this is the exact setup for inflation to climb again. If prices are too high before easing begins, loosening policy will only add more fuel to the fire. Let's get back to the interview.
The Fed stopped short of being restrictive. And although maybe the minute they saw that policy was restrictive, they backed away because Signature Valley Bank and a couple of other banks failed, right? 3 banks failed. And then the Fed stopped hiking rates. So they never got to restrictive territory because credit never stopped expanding, right? Inflation is an expansion of the supply of money and credit, right? I've talked about that. Credit is very important because you don't need money to buy stuff. You can buy stuff with credit, right? And so if you can bid up prices with credit without having any money, and we've raised that to an art form in America. Well, expanding credit is inflation. You've got more credit available to buy goods. And even though the Fed was hiking, the hikes were never substantial enough to restrict the credit growth. Americans didn't stop spending money. They didn't stop borrowing money because rates got too high. Nobody said, interest on the credit card is just too high. I better not use my credit card. I better stop buying things on credit. No, they kept on doing it. They didn't pull back. The government certainly didn't pull back. The government didn't say, interest rates have gone up. We better borrow less money. We better cut our spending and balance the budget because we don't want to have to pay these higher rates. No, they just kept on borrowing and spending, paying no attention at all to the rate hikes because they were too little, too late to make a difference. The Fed never got to restrictive territory, not even close to restrictive territory. People talk a lot about Volcker days and the fact that interest rates got to 20% under Volcker. Well, inflation never got anywhere near 20%. It did get to maybe 10, 11%, at its peak, but other years, maybe 7 or 8%. So you had a Fed funds rate that was more than double the inflation rate, not quite triple, but that was restrictive. Now, we never got anywhere near there. Our inflation peaked out at 9.1, but the Fed basically peaked at interest rates at about 5.25. So our interest rates peaked at half the inflation rate, not twice the inflation rate. And of course, we didn't even measure inflation. If we measured inflation now, the way it was measured in the 1970s, we didn't peak at 9%. We probably peaked at 18%. We probably had a higher peak during this cycle, which hasn't even finished yet. We're still playing it out. But we probably had higher inflation than the peak of the 1970s. But interest rates this cycle didn't even come close to what we got back then. So we never made it into restrictive territory. And what's the reason? Because we're too broke for restrictive territory. We've got so much debt. This is such a massive credit bubble in all aspects of the economy that if monetary policy ever got restrictive, everything would implode, right? So we didn't get to restrictive. We just got less stimulus, right? So instead of the drug addict, the heroin addict going cold turkey, right, and no more heroin, we just dialed back the dosage. That's all we did. We've been taking monetary heroin the whole time. We just took a smaller amount of it, right? That's all we did because we can't get off the monetary heroin. All the Fed tried to do is get us used to a smaller dose. But that ain't going to work. They're getting ready to inject the economy with record amounts of this monetary heroin. And what is going to be the catalyst for that is going to be the bond market. And this is what's coming, because the bond market rallied a bit on Friday. Everything rallied on Friday, right? The Fed gave everyone on Wall Street exactly what everyone wants, right? More free money, cheap money. And, one of the differences, though, in the past, at least, in the recent past, right? When the Fed stepped up, and stepped up meaning not in a good way, but in a bad way, right? But when the Fed came to rescue the markets with rate cuts or QE, the markets at least were going down, right? The Fed at least waited for a big drop in the markets before riding to the rescue with rate cuts, right? Now you have the Fed starting a new cutting cycle, although it's a continuation of the one that started, in 2024, right? Because they never hiked rates. So they cut a few times and then they took a hiatus and now they're going to cut again. But it was, in the past, the markets were down when the Fed came to the rescue. The markets are at all-time record highs. Now, on Friday, the NASDAQ and S&P didn't hit new highs, but the Dow did. The Dow Jones closed the week on a new all-time record high. Yet the Fed is saying, we got to cut rates. Why? The stock market is at a record high. So financial conditions are pretty easy. Why are you starting to cut rates now? Again, even if you admit that there's some risk to the employment, Powell said that it's still 4%. Yeah, maybe it's going to go up, but it's still really low according to Powell. Now, it's really not, again, because the real inflation, the real unemployment rate is a lot higher than 4%. Even the U6 rate is about 8%. That's a lot of unemployment, but the real rate is higher than that. But Powell is still pointing to these phony numbers. So even if you got 4% unemployment and it goes to 5%, so what when you got an inflation problem? And in fact, the whole concept of a dual mandate, I forget, I should have checked the year, but the Fed didn't always have the dual mandate. First, it had one mandate, which was inflation. And in fact, the initial mandate was stable prices. That was the only mandate the Fed had. And stable prices means prices that don't go up or don't go down, right? They stay stable. So that doesn't mean they go up 2% every year. That's not stability. That's increasing prices. So the real target rate of inflation was supposed to be 0. If we had no inflation, then prices would be stable, right? So first, the Fed's goal was no inflation. But then they decided to add the second mandate, full employment, as if monetary policy has any real direct impact on employment. I mean, the only impact it has is negative. I think that Fed policy doesn't create employment, but it can certainly increase unemployment by having bad monetary policy and having too much inflation. I mean, the only way in the past that the Fed was ever able to reduce unemployment by creating inflation was by reducing the minimum wage. You see, if you create inflation, you effectively lower the minimum wage. Now, the minimum wage is a barrier to employment. The higher the minimum wage, the more unemployment that is created. If you lower the minimum wage, you create jobs. Now, politicians don't want to lower the minimum wage. In fact, it's never been lowered. They only want to raise it. And so if a high minimum wage is causing too much unemployment, one way to do that is to create inflation so that the prices of everything goes up, but you hold the minimum wage the same. And so now you're reducing the real minimum wage, right? Because it's not being indexed to inflation. And so that could create some jobs, right? But what's creating the jobs is not inflation. It's the lowering of the minimum wage that was destroying jobs, right? But that's the only thing that the Fed has ever been able to do to help alleviate an unemployment problem is to, secretly reduce the minimum wage without forcing politicians to have to actually cut the minimum wage.
What's unfolding looks less like a regular cycle and more like a slow unraveling of trust in the monetary framework itself. While mainstream coverage is fixated on the same handful of tech stories, the strongest trend of the year is unfolding in plain sight, yet without recognition. The buying patterns of central banks reveal a decisive shift away from dollar assets, while everyday savers continue to treat gold and silver as if the move is already over. Layer on top of that a Federal Reserve that bends its own playbook whenever convenient, and you get an environment where policy no longer guides markets, but markets expose the weakness of policy. The silence around the miners' surge isn't just a missed headline, it's a sign that most investors are being kept blind to where real strength lies. Is the current quiet climb in precious metals and miners the early phase of a structural shift in wealth preservation, or will it take a sudden shock to awaken the broader market to what central banks already know? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.